Hi guys, welcome along to today's webinar. My name's Lucas Rogers from the Rogers Property Group, and you're actually installed for part 2 of our webinar, which is called The Best of Both Worlds. And the best of both worlds is not only getting cash flow positive property, but combining that with capital growth as well. Now, a lot of people are under the false impression that you cannot get positive cash flow property that gives good capital growth, but I'm here to tell you today that that's just not true. You can. I'm getting it at the moment, my clients are getting it as well, and if you're structuring your portfolio correctly, you can have it as well. So you can definitely get the best of both worlds. There's no doubt about that. As I said, my clients are doing it, and I'm also doing it at the moment myself. Some contact details. Look, if you'd like to get in contact with me direct, please email me at info@rogerspropertygroup.com.au or 1300 148 178 is our phone number. And look, we've got stuff coming up out on Facebook and Instagram, so subscribe to those social media websites, and we can keep you updated with the latest happening of what's going on in the property market. So guys, a little bit of background on me for you who have listened to part 1 already. You'll know my background, or people that have dealt with me in the past, but just a quick rundown. My background is I'm a chartered accountant, used to work for one of the big 4 accounting firms. Before I moved to London, worked in investment banks in London for 7 years before returning to Australia to get started in the property investing and property finance. And I'm also a qualified financial planner. I'm a qualified a mortgage broker. And I've been in the industry for well over 13 years, and I've built myself up a sizable portfolio myself, and I've also been involved with hundreds of millions of dollars worth of property transactions through development, capital raising, and so forth. I've also written a book on property investing, which is called The Complete Guide to Property Investing in Australia. For you who would like a copy of it, please send me an email to info@rogerspropertygroup.com.au, and I'd be delighted to send you out a free copy of that. It usually costs, I think it's $29.95, or sort of around $30, but as I said, we'd love to send you out a free copy of that. I do a lot of public speaking. I speak on behalf of the federal government. I've been doing that for over 10 years, teaching the general public how to make money out of property. I've spoken to thousands of Australians about that. I speak on behalf of the National Australia Bank, teaching their clients how to make money out of property, how to build wealth through property. I also speak on behalf of the Queensland Police Department to the recruits as they're coming through the academy, just to how to manage their money and I suppose make money and build wealth through property investing. I'm accredited as a leading property investment advisor throughout Australia. So guys, I've had plenty of experience in the market, and I'm certainly well qualified, so stay tuned. I'm going to give you some tips on property investing today. Now, we've already been through part 1, so bang, that is completed. Now, part 1, what we went through getting your mindset, or through you getting your mindset right to be successful in life and to be successful in property investing. Today, what we're going to have a look at, so part 2 is all based around finance. As I said in my previous presentation, finance and property, they're the 3 parts to property investing. They're on an equilibrium triangle because they're all just as important as one another. Have a bad finance structure, doesn't matter how good your property is, it's all going to fall apart. Vice versa, doesn't matter if you've got a great property, if you've got it poorly financed, then you're going to run into problems as well. So we're going to have a look at finance today. This is part 2, and then in part 3, we're going to get into the juicy stuff in regards to property. So stay tuned, guys. Okay, finance, some of the things we're going to cover today. We're going to talk about various structures, various financial structures that you can buy property in. We're talking about the correct loan structure to have and how to look at that. We're also going to have a look at bank valuations as well and see how they're so important. We're going to be talking about some safety issues when it comes to financing property, cross-collateralizing and so on. And there's a whole lot of stuff we're going to do. So let's kick right along. Okay, so first of all, different financial structures that you can buy property in. These are 4 of the most common ones, and you've got variations on all those. Trusts, companies. SMSF is the acronym for self managed super fund, which is extremely popular at the moment to buy property through and to hold assets in. And then, of course, we're going to be looking at your own name. Now, your own name's not really a separate entity, but we'll treat it as such today. Now, just bear in mind, everybody, I'm not going to present to you today advice on what everybody should be using. I'm not going to sit here today and tell everybody, yes, you all should be using a trust, or everybody should be buying property through a company. That wouldn't be prudent of me, and that would be the wrong thing to be giving advice around. And the reason being is everybody's got individual circumstances. What's going to suit one person is not going to suit another. So for me to sit here and say that everybody should be using a trust would be wrong. So what I'm going to do is I'm going to give you I'm going to explain to you the setup of each one of these, and I'm going to talk to you about the pros and the cons of each of these different structures. Then what you may be able to do is you might be able to apply it to your own set of circumstances and then decide what's going to suit you best. If you'd like to talk to me at a later stage and I can give you some advice around these structures, you know how to get me at info@rogerspropertygroup.com.au. But let's kick on anyway. So a trust structure. A trust structure is made up of this. Firstly, from the top down. Well, I'll go from the middle. That's the trust that sits in the middle. Then above that, a trust needs someone to manage it, or something to manage it, I should say. And we call that a trustee. It manages the trust. Now, the trustee can either be an individual or individuals, or it can be a company. So it might be Rogers Proprietary Limited as trustee for the Rogers Family Trust or something like that. So that's the way that works out. Then beneath that you have what we call the beneficiaries, and the beneficiaries are the entities or the people that actually get the benefit from the trust. Okay, so let's say that there was $1 million in a bank account at a 10% interest rate sitting inside the trust. Then the trustee doesn't really get any benefit out of that, but he directs, or they direct, who gets the benefit underneath that. So the beneficiaries, if there was $1 million if there was $1 million in a bank account sitting in the trust at a 10% interest rate, that means it would be making $100,000 per year, and assuming that each of those beneficiaries gets it in equal share, then that means that they would each get $25,000. So they get the benefit from it. Now, that's just a quick breakdown of how a trust is set up. Now, why do people use trusts? Well, the benefit of owning a trust or running things through a trust is twofold. Firstly, if you're running your business through a trust and that business happens to be earning, say, in this particular case, it's a nice easy one. Let's say that the business was earning $400,000, then rather than paying tax at the rate of $400,000, where everything above $180,000 is taxed at the top marginal rate, what we would do in this case is we would wash that $400,000 over to the beneficiaries, and we'd say, okay, well, each beneficiary gets $100,000. Now, if that means that we're effectively paying tax only at the $100,000 rate, not at the $180,000 rate. So people set these trust structures up because what it does is it saves them. It's beneficial from a tax perspective to do that. That's if the asset is cash flow positive. The other reason why people set up a trust structure, especially when they're buying property and assets and so on, is because it gives them asset protection. So if your properties are held in the name of a trust, then they're very safe from creditors, because it's like somebody else holding that property or owning that property on your behalf, managing that property on your behalf. Okay, and you're the beneficiary. So you get all the benefit out of it, but what happens is you don't get, because you don't own it, if you get sued personally, then the property is nice and safe within that trust. So it gives you a lot of asset protection. And this is why a lot of wealthy families, surgeons, and people that have not necessarily wealthy families have got a high potential to get sued, but surgeons and stuff like that have a high potential to get sued, so they generally put their properties in the name of a trust because it gives them extra added protection. But what are the drawbacks? Why isn't everybody using a trust structure? Well, it does have, while it's got a tax benefit if the property is cash flow positive, if the property is negatively geared, meaning that the income from the property is less than the expenses from the property, meaning it's creating some type of tax loss. And remember, just because it's negatively geared doesn't mean it can't be cash flow positive, but let's assume that it's a negatively geared property, then that negative gearing, so that tax loss, can't be passed down to the beneficiaries, okay? It gets quarantined within the trust. So what that means is that if you own a property, in layman's terms, what it means is if you own a property in the name of a trust, then it can potentially cost you 2 or 3 times out of your own cash flow if you'd purchased it in the name of that trust as it would if you purchased it in your own name, because you don't have access to that negative gearing loss. It's quite a tricky thing, but the bottom line is most people, 90% of Australians, don't need to set up that trust structure because they don't need the extra added protection of that structure. As long as you're well insured, in most cases you're going to be, almost all cases, you're going to be very, very safe. So it doesn't necessarily mean to set up this trust structure. You do have to be a little bit careful of them. Accountants sometimes race to set them up, and lawyers, because they always look at the dark side and think that everybody's going to get sued and stuff, but that's not the case. Very few people that happens to, and it's just not worth it for the extra cash flow it's going to cost you to own it in the name of a trust. So guys, that's trusts. Moving right along from there, we've got our company structure. Now, company looks a little bit like a trust, but it's a little bit, but it is different. So you have the directors of the company. So that might be the board of directors, and they effectively run the company. And they run it on behalf of the shareholders. So the shareholders actually own it. Then the shareholders get things like dividend payouts and so forth. Now, people set up a company structure because they think like a trust, they're going to get some added asset protection. But where I see a lot of people falling down is they own their properties in the name of that company, but yet they're also running their business through that same company. Now, generally speaking, when people are going to get sued, it's generally through a business transaction for some reason or another. They've done something bad, or they're whatever it may be. So if they're holding all their assets in the same entity that's getting sued, you can obviously see the drawback there. The weak spot and what it's going to be is they're going to lose all their houses because they're the same owner. So that's where I see a lot of people going wrong, especially guys that are running small businesses like a little, proprietary limited plumber or something like that. He eventually gets sued because he hasn't done something right and he loses his properties. So your company structure is not going to suit everybody. Also, your company structure misses out on a significant tax benefit of a 50% capital gains tax discount when you own an investment property for more than a year. So, for your normal person, for your living person, they're going to want that as well. So from a taxation perspective, it falls apart a little bit there. So you've got to be careful of a company structure. Company structures really suit people who are flipping and turning over property, builders, developers, turning over property fast, and just want to have a huge safety net there and don't have any other assets in that particular business. So they'll set up what we call a special purpose vehicle, which is really just a one-off company to be able to run that particular venture. Okay, moving on from there. As I said, company structures don't suit many people. We got one too far there. So what we've got there is self-managed super fund. We've got a corporate trustee managing. It's a bit of the same setup as a trust. So you've got a corporate trustee managing the self-managed super fund, which is like a trust. And then underneath that, instead of having what we call the beneficiaries, you now have what we call the members. Okay. So the corporate trustee doesn't necessarily have to be a company. What we can have there is we can also have individual trustees as well. But what we do is we like to set up a corporate trustee just for longevity purposes of the super fund. Then if we're looking at building a property portfolio within the fund and we're looking at borrowing, we need to set up the second part of the borrowing structure, which is the bare trust with a second corporate trustee. Okay, so it's quite a complex arrangement. There's 4 different entities that you have to set up. So you have the corporate trustee and the self-managed super fund combined with a second corporate trustee and a bare trust as well. And that setup allows the fund to be able to borrow to buy property. I won't go into any further about the intricacies of it. So what benefits does it have? What are the pros of setting up a self-managed super fund? Well, one thing is you get to manage your own money. That's one thing. And the other thing is, from a property perspective, is you're able to use leverage through your super. So I'll give you an example. Let's say that you've got $200,000 in superannuation and you put that into a 10% yielding, something that's giving you 10%, then you're going to be making $20,000 a year. But if you got that $200,000 and you put it into a $600,000 property, and that property went up by 10% per year, then you'd be making $60,000, not $20,000. And that's just like leveraging your own personal name. And that's the power of it. It allows you to make bigger gains. So that's the 2 different structures that we need to set up to allow us to be able to borrow. So 1, it gives us the ability to be able to lever. 2, self-managed super funds are very, very safe, meaning that they're like a trust structure. They keep our assets very, very safe from creditors, etc., because they're not actually owned by us. We're just members of that fund. Okay, we can still be on the board of directors of the corporate trustee, so we're actually managing it for ourselves, but we don't actually own it as such. So it gives us leverage, it gives us asset protection, and finally also the tax benefits of buying property through a self-managed super fund are great as well. Meaning that when you hit retirement age and you start to draw money down from your self-managed super fund, everything within that fund becomes tax-free. So if you're 40, if you're 40 years old at the moment, you buy a property and you spend $500,000. And then by the time you're, say, 60 years old, that property is now worth $2 million, which is not unlikely and based on average growth rates. If you were to sell that property in your own, if you had owned that property in your own personal name and you went off to sell it, then you'd be paying tax on $1.5 million gain. Because remember, you paid $500,000 for it. It's worth $2 million at the moment. But if you buy that in the name of your super fund and then you eventually sell it within the fund, then it's sold tax-free. So that's a lot of saving there. On top of that as well, although it's a lot, although the capital gains tax is free, the other thing to bear in mind too is there's no income tax from the fund when you hit retirement age as well and you start drawing an income down from the fund. So if that property that we just referred to a moment ago, rather than at selling it off for $2 million, if you were getting $1,500 a week in rent, that $1,500 per week is tax-free when you hit the right age. So self-managed super funds are a great way to hold property. Not going to suit everybody, so you need to get some advice around that from a qualified person, but they are a great way to hold the property. One of the biggest drawbacks with them is this. At the moment, you need at least $200,000 of superannuation to set one up. That's ASIC's guidelines at the moment. Plus, on top of that as well, they're reasonably expensive to set up. They can cost anywhere from $6,000 to say $10,000 to set up those 2 structures and have everything, with statements of advice and all that ready to go to be able to borrow for property purchase. And the other thing is where they fall down a little bit is they don't have a huge amount of duplication abilities, meaning if you buy a property in the name of a self-managed super fund and that property goes from $500,000 to $1 million in the space of 5 years, you can't then go and draw that equity out from that property and buy another property because you can't set up a loan or you can't draw equity out of a property that's within a super fund. Okay, so we just got to be just a little bit careful of that and make sure that we're suitable for setup. And as I said, you're better off getting some financial advice around that before you plough into that because it is quite dangerous. Because if you go outside of the directions of ASIC, and you breach the super fund laws, then your fund can become non-compliant and so on, and that's somewhere where you don't want to be. Okay, moving right along, buying property in your own name. To be honest, buying property in your own name is going to suit 90+% of Australians. And the reason being is most Australians don't need the added asset protection of say a trust or a super fund or something like that. They just need the negative gearing so they can use it against their taxable incomes to bring their cash flow up. Okay, so it's going to suit people for that. They get a big tax break by buying property in their own names rather than buying it in say a trust, because they can use the negative gearing. So it's a great way to own property. One of the things you've got to watch when you're buying property as a couple is buying property as a couple and you're putting it in say 50-50 names, is that the correct split to be putting it in? You don't necessarily have to buy property 50-50. You can buy it 70-30, you can buy it 80-20. It's all going to boil down to what taxable income each of those partners is on and what your property strategy is. Because if you're a husband and wife and your property strategy is to buy and hold property for the longer term, and the husband is the only one working while the wife stays at home and mind the kids, there's no point in putting that property in 50-50 names, because the wife would be missing out on 50% of the tax breaks that they could be getting, and that has a huge impact on our cash flows. So it's very, very important that you work this out up front. If wife's going off to have kids or husband's taking some time off, whatever it may be. The most important thing around all this is, and this is what I say to my clients, is before you do anything, my advice is to get advice around financial structures. Very, very important to know what you're doing. Okay, moving right along there, correct loan. We're going to be talking about borrowing capacity, or there's lots of acronyms when it comes to property, and BC refers to borrowing capacity, and that is how much can you borrow to buy a property, and that's going to be based around a few different things. It's going to be based around how much money you earn and how much equity you have or how much cash you have ready to be able to put into the property. So in regards to borrowing capacity, I advise all my clients, get to know your broker on a first name basis. Okay, you need to be intimate with them because of the fact that they're going to be the ones who can advise you as to how much you can borrow. And you need to be able to borrow to buy an investment property. So get to know your broker on first terms basis. Okay, know your figures. A lot of people wouldn't even have a clue how much money they owe in their own home or what it might be worth. They don't know how much money they've got outstanding on credit cards, what their car leases are, what this is, what that is. So you need to know your figures. It's like knowing how much money is in your wallet. And then when you know those first two things, you get to know your broker, you know your figures. Then what you've got to ask your broker or know how to do this is, how do I improve my numbers? How do I make my borrowing capacity higher? Because your aim is to buy as much property as you can over a period of time, because that's how we build up a property portfolio. So how do I improve them? There's lots of different ways that you can improve your borrowing capacity, which people, takes no work, but people don't even realize. And one of those is through credit card limits. Now, people think, I need to own a credit card because it gives me a better rating and all this sort of stuff. Not entirely true. You've got to remember that if you've got a $20,000 or $30,000 credit card limit, the bank looks at the limits as debts. It doesn't look at those and say, okay, well, Jim and Betty, you've been paying down your credit card at the end of each month. The bank's not concerned with that. What the bank is concerned with is to how much you can potentially go out and spend tomorrow and incur a debt. So if you've got, say $25,000 worth of credit card limits, and your wife's got $25,000 worth of credit card limits, then the bank's going to look at a debt in your names of $50,000, even if you're paying them off at the end of each month. So be cautious about that. You need to know how to improve your buying capacity. One of the things you got to remember when it comes to property is like a great big game of Monopoly. And what I mean by that is everybody wants the best pieces. So everybody wants the Mayfairs and the Park Lanes and the this and the that. And even if it's in a bad market, so things aren't very strong in the market, the good stuff will always sell, and good deals always sell, and they sell fast. If you're the sort of person, you don't know your own borrowing capacity, so you don't know how much you can spend, you've got no idea of what your net wage is, you've got no idea how much tax you're paying, you don't know what your equity is, then you're not even going to be close to the hunt of finding something decent. Because by the time you've sorted out all your stuff, somebody's already bought that property, because that's how fast good stuff goes. It really does. So keep an eye on your borrowing capacity. As I said, get to know your broker, I think is a good way to go, so they can help you along as well. A 90% LVR. What does that all mean? Sounds a bit strange, doesn't it? Well, an LVR is an acronym. You know, finance has got so many different acronyms. LVR is the acronym for loan to value ratio. And what 90% means, it means that the bank is going to lend you 90% of the asset that you're about to buy. Okay, so how much deposit do you need? 10%. Why am I suggesting that you work with a bank that lends you 90%? Well, you don't necessarily need to borrow 90%. You can always do it on an 80% LVR, whatever it may be. But if you have that flexibility there in case you need it, then that's I'd definitely be looking at a bank that has 90%, okay? And the reason being is, or a good example of this is, let's say that I'm a high-end executive with Westpac, for instance, and I'm right up there and I'm earning my 200-300 grand a year, whatever that may be, and I want to go out and get a loan. Well, wouldn't I be better off, and I've got enough for a 20% deposit, wouldn't I be better off splitting that 20% deposit up into two 10% deposits, and therefore doubling my property portfolio initially, getting that compound effect straight off the bat? That would be a better way to go. I'm on a high taxable income. I can certainly soak up any of those extra tax deductions from the loan, and also from the mortgage insurance as well. So why not go to 90%? It's not going to suit everybody, but I think it's good to have that flexibility there when you need it. And finally, what you want to be doing is you want to make sure that you avoid cross-collateralizing. Now, I'm sure somebody's sitting there thinking, hang on, mate, what the bloody hell is cross-collateralizing? Well, cross-collateralizing is using the same bank on your initial purchase for any of your future purchases as well. You want to try and split everything up so that everything's with different banks. And what that does is that just provides a nice safety net for you in case anything was to go wrong and you look at getting sued, so you didn't lose any properties. Definitely avoid cross-collateralizing. Okay, bank valuations. Now, this is I love this slide. It's quite a tongue-in-cheek slide. Your valuation, that's Updown Court in Surrey in England. And once upon a time, that was the most expensive house in the world. I think it was £150 million. And then on the right-hand side, we've got the bank's valuation of your home. And somewhere in the middle there, in this particular part, in the middle between the two houses, that's where your valuation is, okay? But can I say this? Never get disgruntled from what a valuer tells you. You've got to remember that he is going to be coming from a very, very conservative point of view. The banks do not want anything on their books that they can't sell for a profit, or at least get their money back, within 30 days. So when you're giving your figures to your broker and you believe your house is worth 650, then you want to make pretty sure, or maybe be conservative with that estimate. So I see it on new purchases where the valuation comes in a little bit low because of the fact that the bank thinks that they can't sell it within 30 days and get their money back. So look, as I said, guys, be very, very conservative with your bank valuations. Okay, so I want to give you an example today of one of my clients who has the bones there to be able to do something great, but in the past he hasn't understand the financing of properties, and it's led him down a not so lucrative track where he could have owned more properties and be doing much better now. So this is Dr. Lee. Dr. Lee, great guy. Dr. Lee is immigrated from overseas, judging by the name. As everybody's probably realised. No, he's immigrated from overseas. Came to Australia with nothing, would you believe? But although he worked very, very hard and became a doctor and so forth. Now, what Dr. Lee's done is, or I should say, what he's thought was the way to go is being debt-free was correct. His family's always done to him, you don't want debt, pay off all your loans, pay off all your loans. So he thought that paying down his loans was the best thing to do. Okay, and he also thought that from the country that he came from, apartments were the biggest investment over there. And he thought that apartments in Australia were the right ways to invest as well, but as we'll find out later, they definitely are not. And he had no idea at all about financial structures, okay? Not only that, is he was a little bit worried about his own home because he didn't want to put his own home up for grabs for a loan on an investment property. His wife was a little bit concerned about that. Okay, so that's something we're going to talk about a bit later on. Goals. Now, goals, what did Dr. Lee have? Well, he wanted to retire at 65 years old with an income of 150 grand, and he wanted to maintain his current lifestyle, which was pretty good, and he also wanted to do a fair bit of traveling as well. So let's have a look at Dr. Lee's figures and see how he's stacking up there. So he's 49 years old, and as I said, he wanted to retire at 65. So he has 16 years left to do something. His home is worth $800,000, and he owed $300,000. This is a snapshot when he first came into my office. Okay, his salary is $175,000, so he's doing very well there. His superannuation, he had a bit of superannuation because he'd been working for a little while. $200,000, and he's on such a high taxable income. $200,000, and he wasn't putting anything extra into that. Okay. So he really didn't have any investments. He was solely focused on paying off his own home as fast as he could. So his current outcome in 16 years was as follows. Superannuation, $200,000, that was going to go to around about $600,000. His 9.5% of his salary is going into his superannuation as well. So that 9.5%, that's going to go to $748,000. So he's going to have net superannuation of $1.3 million there. So that looks pretty strong. Okay, now apart from that, he really didn't have anything. He's got his own home, which he's been very vigilant in paying down. But apart from that, and your own home doesn't give you any income in retirement. So we had to have a look and say, okay, well, you've got $1.3 million worth of assets. What's that going to give you at a 5% yield? It's going to give you about $67,000 per annum. Okay, $67,000 per annum. Now, that's going to work out to be, when we take into account inflation, of around about $33,000. So he's a fairly long way off his goal. He's about $150,000 away from his goal. So what do we do? Okay, well, first of all, we got started. As I said, we set some goals. Retire at 65 with an income of $150,000 per year and maintain his current lifestyle. And Dr. Lee and his wife are avid travelers, so he would like to do more of that when he's not working so hard. Okay, what action did we take? Well, we started building a property portfolio. We restructured his finances so he was doing better from a cash flow perspective. We helped him to reduce his tax. He had no, even though he's a doctor and very, very smart, he didn't realise that he could minimise his tax. So he had no tax minimising strategies in place. We showed him how to pay off his own home faster as well by some clever structuring of cash flow. Very, very important, and it means that he will pay off his home loan in probably about, I would say, in 50% of the time that he would have if he didn't put these plans in place. And we taught Dr. Lee that not all debt is bad debt. So he's under the impression, no debt, no debt, no debt, pay off the debt as fast as we can. That's not always the case. You do need some debt to be able to expand your property portfolio, and we demonstrated that to him. Okay, and what was the final outcome at the end of the day? Well, Dr. Lee has acquired no less than 5 properties in 4 years. Been amazing. He's made over $400,000 in capital growth, has increased take-home pay due to increased tax deductions. So because he's saving so much money on tax and he's such on a high taxable income, his properties are not only cash flow positive, but also giving him good capital growth. So he's getting the best of both worlds, and they're also putting $1 in his pocket as well, which is great. He's definitely on track to meet his financial goals. Dr. Lee, he's quite a driven person, and he will definitely meet his financial goals in the next 10, 15 years. And now what he's done is he started teaching his children about property investing, and he's been able now, because they're seeing him, acquire a vast amount of property. He's able to show them the things that his father never showed them, and point out that not all debt is bad debt, and the way to build up a property portfolio nice and safe. Okay, so once you put all the parts of the jigsaw puzzle together, he was fine. So guys, that's probably the most boring part of property investing, is the finance part. Okay, let's give that a stamp. Bang, done. We've got that out of the way. So that's probably the most boring part, and what we're going to do is going to move on in the part 3 of this particular webinar, and we're going to be talking about properties themselves. So guys, stay tuned for that. And this is how the next lesson is going to look. So we've done looked at property. Thirdly, we looked at finance, and thirdly, we're going to be looking at property. Rogers Property Group, what do we do? Well, we provide independent advice and set up everything right from the start. We make sure you get the right financial structure, self-managed super funds, trusts, etc. We also research locations and statistics to make sure that where we're putting our clients, they're not in areas that are oversupplied or anything like that. And we do cash flow analysis for our clients, which is very important. And finally, help you organise your team of professionals around you. Okay, so that's about all we have for today. That's our second part of the webinar done. That's the finance part. Stay tuned, and we'll get on to the third part, which is the property part. And we're going to get into some really juicy tips and tricks on how to maximize cash flow and maximize capital growth from your property. If you want to get in contact with me, if you'd like to request a copy of the book, please do. Email address info@rogerspropertygroup.com.au, or you can give us a bell on 1300 148 178. Please also like us on Facebook and Instagram as well, and you'll receive all updates. Thank you.